Real-world examples. Introduction. Business funding is not just about getting money. The amount of money a business has, when it gets that money, and how it uses it can have a major impact on its ability to survive and grow. To understand this, we are going to look at 3 real businesses and what actually happened to them. Our first example is Kune Food, a Kenyan food tech company. Its story will help us understand why too little money can kill a business, even when the business has customers and a product that people are buying. Our second example is Quibi, the short-form streaming company. Its story will help us examine why having access to a very large amount of money can lead to excessive spending and waste, particularly when a business spends heavily before proving that its market will support the model. Our third example is MailChimp, the email marketing company. Its story gives us a different perspective, finding a funding approach that matches the way a business grows, rather than assuming that more external funding is always better. We will examine these businesses in that order. For each one, we will look at the money available to the company, how that money was used, the financial challenges the business faced, and what ultimately happened. Then we will compare the 3 examples and use real financial statistics to see what the numbers tell us. These are not hypothetical business A, business B and business C scenarios. Kune Food, Quibi, and MailChimp were real businesses, and the events we are about to examine actually happened. Let's begin with Kune Food. Real-world examples, comparing the 3 businesses. Business A, Kune Food, when funding runs out. Kune Food is our first example because its story demonstrates what can happen when a business reaches a point where its available capital is no longer enough. The company had already raised $1 million. It had customers. It had sold more than 55,000 meals and acquired more than 6,000 individual customers. So this wasn't simply a case of a business having an idea that nobody wanted. The company was operating. But Kune needed additional funding to continue its growth. It planned to raise another $3.5 million, but the funding environment became more difficult and the company could not secure the next round. At the same time, rising food costs put additional pressure on its margins. Eventually, Kune ran out of money and shut down in June 2022. The important point is this. A business doesn't necessarily die because it has no customers. It can die because it runs out of the cash required to keep operating. Kune therefore gives us our first lesson. Too little available funding can kill a business. Business B, Quibi, when capital enables excessive spending. Our second example is very different. Quibi entered the streaming market with enormous financial backing. Before it had demonstrated that consumers would pay for its service at scale, the company had raised approximately $1.75 billion. More than $1 billion was committed to content production. That gave Quibi the ability to spend at a scale that a young startup normally could not. The company invested heavily in expensive productions and high-profile talent. But the critical question was not, can Quibi afford to produce the content? It was, will enough customers pay for it? The company launched in April 2020. Less than 7 months later, Quibi announced that it would shut down. It reportedly still had approximately $350 million in cash when the shutdown was announced. So Quibi demonstrates something important. Having money available can solve a funding constraint, but it can also make it easier for a company to commit large amounts of money before the underlying business model has been sufficiently validated. This gives us our second lesson. Too much available capital can create the conditions for wasteful spending if financial discipline and validation are weak. Business C, MailChimp, finding a different funding level. Our third example takes us in a completely different direction. MailChimp was founded in 2001. Its founders chose to build the company without outside funding. Instead of repeatedly raising capital from investors, the company grew through the revenue generated by its own operations. This meant that the company had to grow according to what its business could support. It couldn't simply raise another large investment whenever it wanted to dramatically increase spending. Yet the company still achieved substantial growth. By 2020, MailChimp had reached approximately $800 million in revenue. Then in 2021, Intuit acquired the company for approximately $12 billion. MailChimp demonstrates that there is another approach to funding. A company does not necessarily need enormous external investment to create substantial value. Sometimes, the better approach is to allow the business's own revenue generation to determine how quickly it expands. This gives us our third lesson. The right funding level is not necessarily the largest amount of funding available. It is the amount of capital that supports the business without forcing the company into unnecessary spending or leaving it without enough runway. What the three businesses show us. Now the three examples can be compared. Kune Food shows the danger of running out of capital. Quibi shows the danger of having enough capital to spend aggressively before proving that customers will support the business. MailChimp shows that a company can grow substantially by relying on the resources generated by its own operations. The three stories therefore lead us to an important question. Is the goal to raise as much money as possible? Not necessarily. The better question is, how much funding does the business actually need to achieve its objectives, and how effectively can that funding be converted into sustainable revenue and growth? That is what we will examine next using the financial statistics from these real businesses. Yes. Now we should make the statistics table from the three actual businesses, not introduce unrelated industry statistics. I also want to make one correction. Kune's $3.5 million was the funding it was seeking, not funding it successfully raised. It had raised about $1 million before the shutdown. Statistics from the three real businesses. Kune, the company had raised $1 million and had real traction, including more than 55,000 meals sold and more than 6,000 individual customers. But its founder said the $3 per meal price wasn't enough to sustain growth, rising food costs hurt margins, and the company couldn't raise its next round. It therefore shut down. Quibi, it raised about $1.75 billion and had a content budget of more than $1 billion. Yet it failed to gain enough paying subscribers and announced its shutdown less than 7 months after launch. Reports said it had about $350 million remaining in cash. MailChimp, it took the opposite approach. Its founders rejected outside investment and bootstrapped the company. Forbes reported revenue reaching about $800 million in 2020, and Intuit's SEC filing confirms that it acquired MailChimp for $12 billion in 2021. Why great ideas still fail? You can have a great idea. You can have a talented team. You can even raise millions of dollars. And yet, the business can still fail. Why? Because a great idea is only the beginning. In our next video, we look at Quibi, Kune Food, and MailChimp and uncover what their stories can teach us about funding, business models, execution, and sustainability. Is having a great idea enough to build a successful business? Watch the next video and find out. Coming next from Peens Technologies. Subscribe to our channel so you don't miss it. We share practical insights on technology, business, software, and entrepreneurship to help you understand what it really takes to build and grow a business. Subscribe and turn on notifications.